Good evening, depending on wherever you are in the world, everybody. Thanks for joining us today. This is our second session today, Mastering UK Property Investment Taxation in 2024. So detailed subject, lots to cover. To introduce you to Laurence in a second. My name's Andrew Siegel. I'm a managing partner at Joseph Mews. Guy on the left of the picture there is another managing partner, Johnny. He's actually based in Dubai, so he's not going to be on the call this morning. So, as I say, I'm going to introduce Laurence in a second. We do these, we had a little break in the summer, so we do these webinars monthly. If you go to our YouTube channel, you'll see lots of other content about particular developments, location, rentals. So hopefully a lot of good sort of educational content there. And of course, a lot of moving parts in a property investment, and taxation obviously is an important part, which is why we're pleased to have Laurence on. If I could have the next slide, please. Thank you. And the next slide. Most of you, I think, that are on, we've got a huge number on today, so thanks for attending. I think most of you are from our database, so you know us. We're a promoter and we're a property developer. We've got a fantastic track record since about 2001. And we partner with some of the best developers out there. And we're a one-stop shop for our clients. So not only do we do the sales and the marketing, it's pretty straightforward, but we do the handovers, the customer care, the lettings. We can help with tax, and we have fantastic trusted partners like Laurence, who've been working with a long time, that can give the right kind of advice to make the investment as lucrative as possible. I'm sure, again, depending on the audience out there, we probably know that the UK is the most invested property market in the world for obvious reasons, I suppose, but quite a low price point, depending where you're buying. Fantastic capital appreciation. Property prices have doubled on average every 13 or 14 years. The law is clear. The taxation is clear. Unfortunately, like most countries in the world, we have to pay tax. It's a necessary evil. But hopefully with partners like Laurence, we can make that a little bit easier and a little bit more palatable. We're not really going to talk about, I don't think we'll have time to talk about particular developments, but for those interested, we've got plenty of exclusive stock, which give low price points and the high rental yields. If I could have the next slide, please. Thank you. Again, I think just to sort of break it up a little bit, and certainly learning from this morning's webinar, let's, you've got the little Q&A box there. So as we go along, please put in any questions and we'll attempt to answer as many as we can on that particular subject as we run through the webinar. We'll try and keep it relevant because, of course, everyone's tax situation is going to be different. So there might be some specific stuff. And what we can do, we'll have a little tick box at the end of the webinar. We'll be able to tick a box and you'll be able to get a little free consultation to be able to speak with Laurence directly to answer more, I guess, more specific questions that are relevant to your circumstances, you know, depending on where you are in the world. So if I could have the next slide, please. Okay, so I'm going to hand you over to Laurence. He's the founder of Hodgens Global, specialist UK and expat tax advisor, and he'll run through a handful of slides. I'll pop in and out with the Q&As, and then we'll have a summary and a Q&A session at the end. So hand over to Laurence, and thank you very much.
Thank you very much, Andrew. Hello, everybody. Good afternoon, good evening, wherever you are. My name is Laurence Hodgens, and I help a lot of people all around the world with their property interests in the UK. UK property does have tax reporting obligations if you're in receipt of rental income or if you happen to make a chargeable gain. It's all subject to annual reporting, and I'm here to help you with it and to help you understand what's involved. Now, if you want to become a property investor, become a landlord, then there are annual tax reporting obligations. I will be able to support you throughout that process. That's something that I can take off your hands and make you fully compliant. So let's start with the next slide, please. And the slide after, actually. Okay, so whenever you invest in property in the UK, you will either rent it out and later sell it. But if you rent it out, you're going to have rental income to declare. And that rental income is taxable in the UK. As your tax agent, I can help you prepare and file tax returns annually so that you don't need to worry about it. You just focus on your investment, and I will take care of the tax reporting matters. So apart from income tax and rental income, the gain will also be assessed. When you come to sell the property, the gain will be assessed for capital gains tax at the end of the ownership period. But also when you acquire the property, there's stamp duty to consider. Currently, if this is a first-time purchase, there's a tax-free allowance of £250,000. So there's no stamp duty on a first-time purchase of the property if it's less than £250,000. But that is only until the 5th of April 2025. From the 6th of April 2025, that £250,000 bracket will drop to £125,000. So now, if you have any properties in your site that are less than £250,000, now might be a good time to do it to avoid the stamp duty. Currently, the stamp duty on a property is 5%. It's 3% if it's a first-time purchase and it's valued more than 250,000, but it's 5% if you're buying an additional property from buying an additional property. It goes up to 5%, and then if you're buying it from overseas, the stamp duty goes up to 7%, because overseas buyers attract a further 2% surcharge on stamp duty. And so we're going to discuss these things as we go forward in this webinar today. So next slide, please. So what measures exist for you to reduce your tax exposure on your rental income? If you take out a loan on the property, then the mortgage or the interest charges incurred in financing the rental property are not treated as tax deductible, but there is relief against any rent due, any tax due on the rental income. There is relief of 20% of whatever interest charges are incurred on the home loan. And this can be quite beneficial. Previously, it was treated as a tax deductible at whatever tax rate you would have to pay, but now it's only been limited to 20%, and so we would declare that in your tax return, and if there was any tax due on the rental income, 20%, it would be reduced by 20% of the interest incurred. Another relief available to you is the tax-free allowance, the annual tax-free allowance. Currently, it's £12,570. This is available to UK residents and to EU citizens. And so if your rental income totals less, your net rental income after related rental costs, if the net margin is less than £12,570, you will have no tax to pay if there's no other income to declare. But you still have an obligation to file a tax return to declare what's going on with the rental income and to let HMRC know that it's covered by the tax-free allowance. At the same time, there's double taxation agreements with various countries around the world, wherever you may reside. And those double taxation agreements, they allow you to offset, they may allow you to offset the tax paid on your rental income in the UK against any tax assessed in the country where you reside. This would be known as foreign tax credit relief, and I can discuss that with you in greater detail when we eventually talk together. However, it all depends on the double taxation agreement as well, whether or not you are entitled to the annual tax-free allowance, even if you're not British or an EU citizen. In some cases, the double taxation agreement will allow you the £12,570 tax-free income allowance if you are a native of the country with the DTA agreement with the UK, and if you're also resident in the country. So it's very important that to understand that a lot of your rental income could be tax-free if you have a double taxation agreement that allows you as a native and as a resident of the country to benefit from that tax-free allowance. So, but we can discuss all this in due course. I'm trying to go very quickly here because we've had the session earlier and it took a very long time. So excuse me if we move to the next slide. Any questions at this stage, by the way? Excuse me. Andrew, have any questions come in?
Yeah, just a couple, just to sort of break it up a little bit. And some might get answered as we go through, so we can do, depending on timing, happy to do a little bit of Q&A at the end.
Yes.
One for me, actually, which is an easy one. Thanks, Arthur. What type of ownership? Oh, sorry. What my brother and I would like to build a property portfolio over time. Yeah, we've got a webinar actually that talks about, which is on our Joseph Mews YouTube channel, talks about how to build a portfolio over time. And if you come back to us at the end, we can always talk to you on a sort of one-to-one basis and let you know how we can work with you to achieve that. We do that for a lot of clients. If the property in the UK is owned by an offshore company, how does that affect the tax position?
Well, this is quite a technical one. I was hoping to talk about individuals rather than offshore companies.
Don't worry.
Yeah, but if offshore companies, there's still going to be a tax reporting obligation.
Yeah,
it falls within various other rules. So, can you send me the name of the inquirer, and I will make
at the end we can get anyone who wants a sort of a consultation just to register. So that's an easy click box come the end of the presentation. To start, this might be a little bit more straightforward. To start paying rental income, at what stage do you have to register as a taxpayer in the UK, and what's the process for that? Okay, so this is this needn't be a concern from the very outset. So what would happen currently under current rules, there's some developments further down the pipeline, but currently you may start receiving rental income, and then only at the end of the tax year do you have an obligation to file a tax return. But even at the end of the tax year in the UK runs from the 6th of April to 5 April. And then from the following day, from the 6th of April, you can file a tax return until the reporting deadline of 31 January of the following day. So if you start receiving income on the 6th of April, you don't need to worry about filing a tax return to declare it until the 31st of January of the following
Well, so you
Yeah,
receive the income on the 6th of April, you have until the 5th of April of the following year, and then you have until 31 January of the following year to have, as a deadline, to have filed a tax return to declare the rental income. So you do have a lot of time. So I recommend you just focus on the investment, focus on what you want to achieve, and then I will deal with the tax reporting requirements at the end of the tax year.
brilliant.
Yeah, so
That's what,
it's not a priority
yeah. And you're there to
at the
advise,
outset.
obviously. That's
Mhm.
your role, isn't it, Laurence?
Yes.
I've got a nice one here. I think, do I get the tax relief on do I get the tax relief on interest, even if the
Uh,
loan is taken from an overseas bank?
yes, that will still be the case. So if the loan is um, if the loan is entirely related to the rental property, then you are allowed 20% relief, as I discussed, of the interest charges incurred. Yes, that can be taken into account. Yes.
I think I've got a quick one here from Shante. Thanks, Shante. Does the UK and Netherlands have double taxation agreement?
They do indeed, yes.
Okay,
So the Netherlands will recognise any tax paid in the UK.
lovely. And just the last one, I think, for this section, because we get quite a few in, and it's also from Shante. And I think you're going to cover this anyway, because I know I heard it earlier on. Is it better from a tax perspective to set yourself up as a company, I suppose, as a limited company?
Well, we discussed this a lot earlier in the earlier session today, and my recommendation is if you're only going to invest in one or two, possibly three properties, and you do not need much of a loan to acquire those properties, I think it might be a good idea to just keep them in your own name. However, if like the earlier inquirer with his brother, he wants to build up a large property portfolio, then it's best to do it under the company, because then under a company, the banks will be much more comfortable with the financing that they're providing, because it's with the company, they feel a better sense of protection. And then all the finance costs will be offset fully against against all the income within the company, and the company will be subject to corporation tax rather than income tax. And at the moment, though, for a lot of people, the individuals, their tax bill could be 20% after the tax-free allowance of £12,570, whereas in the corporation, the corporation tax could range from could be as much as 25%. There's lots of pros and cons. We can talk about them when
I was going to say,
on a
I think
one-to-one basis.
yeah,
Mhm.
exactly.
Mhm.
Everyone's situation is different, slightly different. So yeah, we can cover that at the end and have a more of a bespoke service, because as you say, it's definitely right for some people and not right for others.
That's
Brilliant.
right.
Thanks for that. Let's
But
get back to the presentation. We can always pick up on some more
okay.
Q&A.
Mhm.
So okay, I'll hand you
Yeah.
back to Laurence. Thank you.
So, have any of you filed tax returns previously in the UK? Or do any of you have a UTR number that you've obtained in the past and haven't used recently? I'd like to know who's familiar with HMRC, with UK tax reporting. So let me know, yes, no, or you're not sure. The UTR is the unique taxpayer reference code of each taxpayer with UK income to be declared. The UTR is effectively a TIN, which in America they refer to as a tax identification number. And it's different from your national insurance number. So I'd like to, so yes, so the majority of you, 54%, have a UTR number. So once you start receiving rental income, it should be very easy for you to whenever you're ready to start preparing a tax return and filing. But if you don't have a UTR number, then I can step in, I can help you obtain one. And if you're UK resident, it's very simple. You can apply separately yourself. If you're non-UK resident, and if you haven't lived in the UK before, then you won't have, possibly you won't have a national insurance number. And normally a national insurance number is required to obtain this UTR number. However, as your tax agent, I can help you obtain the UTR number needed without having the national insurance number, etc. But that can all be done through me, and that will help you relax about your tax reporting obligations, because I'll take it off your hands, and I'll even, once I'm your tax agent, once the authorization is in place, I can liaise with HMRC directly on your behalf, which will be will make things easier for you, especially if English is not your native language, etc. And I can phone them and I can speak to them, etc. on your behalf. So if ever they raise any queries about why you're not declaring rental income, because ultimately in the end of the day, they will know you own a property, your name is on the title deeds, but someone else's name is on the council register, paying council tax, etc. So they will ultimately know. And if you put the house on Airbnb, etc., Airbnb will tell them that you are in receipt of rental income. So there's no need to worry about all these things, because I'm in the background and I can help you be fully tax compliant. So, but for 54% of you, perhaps you can even file your own tax return with the rental income. So, okay, so next slide. Okay, so here we're talking, so we can go to the next slide after this as well. Sorry, so go back. Yes, that slide, yes. So there are opportunities for you to set up a UK company or even acquire the property through a non-UK resident company, or through a partnership, etc. But I want to focus really on UK resident individuals and non-UK resident individuals. And if you want to discuss these other opportunities, these other structures, then get in touch with me separately and we can discuss them individually. However, I want to add that if you buy through a company, the stamp duty would be much more significant. Stamp duty is currently 15% for companies, and it's going up to 17%. So you have to be really sure you want to do it through a company if you don't have too many properties to start off with in the beginning. Okay, so next slide. So I think we're missing some slides. Okay, so yes, so what I wanted to say here is really about we've covered financing costs. We've talked about tax deadlines. So the other issue here is tax reporting and capital gains tax. So tax reporting has to be done annually, but at the moment the UK are introducing a reporting method called Making Tax Digital, whereby they want income tax returns filed quarterly. But that is only in an instance where your income, your personal income, exceeds more than £50,000 a year. So, so if that's the case, then the new system is going to be introduced by the 6th of April 2026. And then by the 6th of April 2027, 50,000 will drop, the 50,000 threshold will drop to 30,000. And then by the end of this current parliament, within 5 years, it should drop to £20,000. So those are additional tax reporting obligations that will come into effect. It's going to take some time to adapt to. However, What HMRC intend to do with the Making Tax Digital is they want everything to be digitized. So they want access to all the income records. So you have to use approved software, and they want access to all the costs. And the software will automatically lift the data and put it into the required reporting formats. This will be done quarterly, and then at the end of the year will be done again on an annual basis, and then finally on another basis as well to reconcile everything. So that's going to be quite a process, but also it's going to require access to your bank account. So you may want to create a separate bank account for your rental income, which is to safeguard all the other transactions within your bank account, to have one specific bank account that is accessed by the software and to complete the tax reporting. So that's an issue further down the line that you might want to be aware of. And then there's capital gains tax. So whenever you sell a UK property that you've been renting out, you have an obligation to file a capital gains tax return within 60 days of selling the property. And any capital gains tax due on the sale will be required within the same time frame. And I can help you with that process as well. So any questions at this stage?
Just having a look at a couple of generic ones. For a non-resident, what's the best way to send money for the property investment? That'd be bank to bank. It would go from your bank to not to us, not to the developer, to the solicitor's bank. And you might want to use a foreign exchange company just to keep the charges down. And we have partners that can help there as well. So that's pretty straightforward. Or the developer don't handle your money. It goes from your bank to your nominated solicitor here in the UK. Is there any level of investment in the UK that qualifies non-resident foreign investors to be a citizen? No, there isn't. There isn't
No.
a citizenship program. I'm right there, aren't I?
Yes, that's right. Yeah. So we have a lot of people all around the world investing in property around the UK, and they've never lived there. They don't have any intention of living there, but they're making good returns. But I help them with their tax returns. I've found in the Middle East, I've found people investing in rental property, but they don't know how to file tax returns and how to obtain a UTR number, etc. So I've been helping them with that, etc. But once you're up to date, you've got nothing to worry about. HMRC will not give you any problems as long as you're filing tax returns, and that's something I can take off your hands. It's not an issue.
And they like it when someone like you's involved because they know it's done properly. So it's
that's right. That's right. Yes.
Now is this a bit cross on a property at around about £150,000? Does the 15 to 17% stamp duty apply when purchasing through a company, or is there a 250k minimum amount before stamp duty applies when purchasing through a company? Does that make sense?
Yeah. Will it be a first time? It's going to apply through the company. The stamp duty is going to apply.
Yeah, the investors, their stamp duty is applicable anyway. Yeah.
So if you were a private individual and this was the first time you'd ever bought a house, then there would be no stamp duty. But it doesn't apply for companies. But I can look into that. Brilliant. So next slide. Yeah, so as a non-UK resident, all you need to worry about is how are you going to own the property? Are you going to do it through a company, or are you going to do it as a private individual? Again, with company, there's more stamp duty to pay. As a private individual, the stamp duty is much lower, and this should be taken into account if you are not a multiple property landlord or in the early stages of being a multiple property landlord. And then there is a requirement in the UK for income earned from UK source property to be declared, no matter where you are in the world. That income needs to be declared, and from that we can offset various costs that we'll come to talk about in the following slides. But I can take care of all that for you. But that's the annual process. If your income is less than £20,000, again, we do not need to worry about making tax digital and the multiple reporting. And if your income is less than £12,570 and you're entitled to the annual tax-free allowance, then there'll be no tax to pay on your rental income, but there is the need to file an annual tax return. That's the only requirement. And then we come to capital gains tax. So let's say after a few years you want to sell that property. You need to consider what is the gain between the selling price and the cost price. And then from that, you can deduct the stamp duty that you've paid. You can deduct the legal costs on acquisition, and you can deduct the legal costs on selling the property. And you can also deduct the estate agent's commissions, etc. And also, maybe you've owned the property for 20 years. Maybe you've knocked down a wall or changed the kitchen or something like that. Those costs, as long as they can be documented and evidenced, those costs can be offset against your chargeable gain. If those costs are treated as capital costs rather than rental costs, they can be offset against the chargeable gain. And currently, if you're entitled to the annual tax-free allowances, there's a separate annual tax-free allowance for capital gains of £3,000, and then whatever chargeable gain remains will be assessed for tax at either 18% if you're a basic rate taxpayer or 24%. Again, rental income is reported currently on an annual basis, but capital gains tax needs to be reported on a real-time basis. So you have 60 days from date of sale to file a capital gains tax return, and I can help you with that process. Okay, next slide. Any questions at this stage? But oh yes, full question. Are you planning to rent out your investment for the long term or sell it within a few years? It'd be interesting to know who is got long-term rental in mind or is looking for is buying with a view to selling within a few years. Please let me know. So with long-term rental, it's 67%, sell within a few years, 11%, and 22% not sure yet. So those who sell within a few years, it's not sure how the capital gains tax rules will change.
Yeah.
But at the moment, the basic rate is 18%. In previous budgets, it's always been threatened to go higher, but it never happens. But long-term rental, go ahead, sorry.
Yeah, I was going to say, what I would say is really long-term rent is perfect, really. If you're if you're in it for the short haul, like a year or two, I'd probably say, although I hate to say it, property may not be for you. It depends, obviously, if you're in it for the long term and you need to exit, you can exit. It's a reasonably sort of liquid asset. But you've got to be with the capital gains, or more importantly, the stamp duties and costs, as we've seen since the late 60s, property prices on average will double every 13 or 14 years. So with interest rates, et cetera, et cetera. You need to be in it for the long haul.
Yeah.
Whilst costs are going up, what is really important is the rental demand is huge. This doesn't sound true. I had a lady in Wakefield had a house. She had to put on the market for rent, 840 viewings for one house. On average in the UK, there's 17 to 25 people looking for every one dwelling, one house, one apartment that goes on the market. So it's a strong market. And because of that supply and demand dynamics, the rents are going up. So you're clawing back some of this additional cost purely on the supply and demand. But I'd be realistically, I'd be looking at least a 5-year hold. Would you concur, Laurence?
Yes, I would. I was going to say that in my experience, the longer term rental objective is much more rewarding. At the same time, you've invested a lot in acquiring the property, you've done all the paperwork, you've paid the stamp duty, you've paid the legal costs, etc. It makes sense to hold on to the property for as long as possible and to get as much rental income. When you come to a point in life where you have that rental income coming in, it can be a good source of income for you, and it can turn out to be a good investment. And I don't want to influence anyone, but in my experience and what I see from my clients, I think the sooner you start, the better as well. If you have the liquidity, if you have the opportunity to make such investments, then the long-term rental option could be. I think Johnny mentioned earlier that there's like 250 people for every new rental, etc.
We've got, depending on location, it's 17 on average. There's 17 to 25 people looking for every one property market, one property goes on. As I mentioned earlier, that extreme case, there's 840 people wanting to view one 3-bed house actually in Wakefield. So it's those supply and demand dynamics are crazy, and that's good. As a landlord myself, I've never known it so good in terms of the supply and demand dynamics. You know, you rent everything out literally the same day, and there are other areas that perform better than others. But generally, as we all know, which is probably why you're on the webinar, the UK is a very strong, safe, secure market.
Okay, so next slide. So, can we move on to the next slide? So, in terms of income, I wanted to say that if you were to acquire the property, move into the property, and rent out a room to a colleague or to a friend, etc., you're entitled to up to £7,500 tax-free from renting from a scheme called Rent a Room, and this doesn't need to go on a tax return, etc., etc. So that's for those who might consider living in the property. But that we talked about this earlier because someone asked earlier if there was a minimum limit to the rental income that meant you didn't have to bother reporting. But in all cases, you do have to report rental income when you receive it, except in this case, in the rent-a-room scheme, unless if you were doing a tax return, if you did do tax returns, you would mention it and it would still be covered as tax-free. But if you don't have any need to file a tax return, there's no need to create one just for the rent-a-room scheme. So can we go to the next slide? Because I'd like to talk about deductible costs. So you're going to declare your rental income, and from this we can reduce the taxable amount of the income by various costs like ground rents, service charges, etc. Estate agent fees, estate agents will do the advertising for you, etc. Bad debts, if you have any bad debts, which happens sometimes, but not too much. And then the finance costs, you'll get 20% relief for the finance costs. Can we go to the next slide, please? Yeah, so here, what I wanted to highlight is repairs and maintenance are treated as tax deductible. Then there are travel costs. If you're living overseas and you need to attend to a matter on your rental property, then HMRC, the UK Tax Office, will accept those travel costs as tax deductible, but only if they're wholly and exclusively related to the rental property. So if you fly out to the UK and you visit friends and family, then that won't be allowed. And then you might want to rent out the property fully furnished with gas and electricity included, etc. If so, the income you have to declare can be offset by various other costs involved, etc. Any questions at this stage, Andrew?
Yeah, a nice one here, I think. Thanks, Arthur. Assuming that you own several properties in a company, can you offset any rental profit of some properties against other property loans?
Yeah, I think you can. You would do it collectively, yeah. So it'd be fine.
Okay. How is inflation accounted for in capital gains tax?
Well, again, the capital gains tax is just going to be selling price less original price. So it's going to be the pure gain, but
Yeah,
taking
it's
all the
not,
costs
it
into
doesn't
account.
fluctuate with
No,
inflation. It's
no.
just a fixed percentage, isn't it? It might change
Yes.
over the years with different governmental regimes, but that remains the
Yes.
same.
Mhm.
Do you pay any capital gains tax on a residential mortgage?
Well, so what's going to happen is you're going to sell the property, a mortgage property. So you're going to be assessed for capital gains tax as selling price less the cost. Those proceeds are then going to be used to cancel the mortgage, but the mortgage does not feature within the chargeable gain. So when you sell the property, the sales proceeds, part of those sales proceeds will be funneled towards the loan to clear the loan. Once you've cleared the loan, then the title deeds can be released to the buyer.
And this is a residential mortgage rather than the buy-to-let mortgage, so no capital gain on a residential mortgage rather than a
Well,
buy-to-let mortgage.
it's a buy-to-let a buy-to-let is a residential property. A home is a residential property as well. So the mortgage on that will not feature as a cost in assessing the chargeable gain. The loan will be cleared with the sales proceeds, with the cash collected on the sale, but still the sale will be assessed for the gain made between selling price and original cost price.
Thank you. Just got a technical question. Is there any way the volume could be turned up? Anonymous attendee, that'll be on your side. You need to turn the volume up on your computer so you can do that. We don't control that, unfortunately. Okay, fantastic.
All right.
I've got some more questions, but we'll come back to a few more as we run through, Laurence.
Okay. So do we have another poll now, or do we have another slide? Yeah, so this is I wanted to ask this question because I'd like to let you know what's possible to reduce your exposure to capital gains tax. So are you considering living in the property? No, you have no plans, or you're not sure? Let me know, please. So more than or 50% of you don't want to live in the property, and 33% of you are considering it. Okay, so and 10% are not sure yet. Okay, so the situation is in the UK, if you buy a property and then live in it for a period, it's possible that HMRC, the UK Tax Office, will treat this property as your main residence. And if you were to live in the property as your main residence, then that time will be exempt from capital gains tax. So if you, after a year or maybe two, but even after a year, if you leave to go to work overseas or in another part of the UK and live in another property, you could ask HMRC to treat that property still as your main residence. So if you return to the property and then sell it at a later date, then that property could still be exempt from capital gains tax throughout the whole period of ownership. However, if you haven't lived in the property at the beginning, and then you do move into the property, let's say after 5 years of ownership, then those 5 years will be exposed to capital gains tax. But let's say you own it for a total of 10 years. The second 5 years where you lived in the property will be exempt from capital gains tax. So so the chargeable gain will be time apportioned. And so those first 5 years will be exposed to capital gains tax, and the other 5 will be eliminated. And then from that, so the chargeable gain will be selling price less selling costs, less legal costs on sale, less legal costs on purchase, less stamp duty. And then 50% of that gain will be eliminated because it's not exposed to capital gains tax. And the remaining 50% will then be considered for capital gains tax after taking a capital gains tax allowance into account, which is currently £3,000. And then whatever remains will be exposed to either 18% tax or 24% tax. And then if you just don't live in the property at all, then the whole gain is going to be exposed to capital gains tax. So it'll be selling price less the costs, as we've discussed, and less the tax-free allowance, and the whole gain will then, and none of it will be exempt from capital gains tax. The whole gain will be exposed to either 18 or to 24%.
I think that tied in just, sorry.
Yes.
I've got just a question from Abdul, which ties in nicely, I think. Is there any timeline after which the property becomes free of any capital gains tax?
So let me think about the question. Is there any timeline at which the property becomes free?
So if you own it for 100 years, are you exempt from capital?
No,
I think
no,
you're
no,
always
excuse me, no. So, well, under current rules, no. So, if you have owned the property for 3 years and then you sell it and you haven't lived in it, it'll still be exposed to capital gains tax. If you own the property for 50 years and you haven't lived in it, it will still be exposed to capital gains tax. So under current rules, there's only exemption from capital gains tax for periods when you live in the property. And for that to happen, you need to have a reasonable period of residence. And in a recent court case, it was established that a reasonable period of residence is 91 days, more than 91 days. And that means that you could have a tax year of relief for capital gains tax. But anyway, these are things to think about. Capital gains tax needs to be reported within 60 days of selling the property and paid within the same time frame. It's a bit of a complex process, but I'm here to help you with the process, and it's something I can take off your hands.
Perfect, thanks.
Okay, so next slide. So I've done a lot of talking. So the summary is that you'll have rental income, but not all of it will be exposed to UK tax. because you are able to deduct estate agent fees, deduct repairs and maintenance, deduct any other costs related to the property that that's incurred while you're renting out the property. You have capital gains tax issues to consider, but these will only be a matter when you come to sell the property, and you don't need to worry about it in advance. At the same time, we've understood also about the tax reporting deadlines. Reporting rental income shouldn't be a concern for you. Once you start receiving rental income, you have time to file a tax return. And as your tax agent, I can guide you throughout the process. And then, once you start building your property portfolio, we want to discuss whether or not creating a company makes sense. And at the same time, for individual landlords, who have rental income of less than £12,570, while there's a tax reporting obligation, there might not be any tax to pay if you're entitled to the annual tax-free allowance currently of £12,570. And that is available to you if you're a UK citizen or an EU citizen, or quite possibly if you're in the country with a double taxation agreement with the UK and you're both a native of the country and a resident of the country. So there's all these things to be taken into account. It's very important that when you're doing tax returns that the right boxes are ticked if those allowances are available, and so I'll handle all that for you. And it would be a pleasure to be your tax advisor on all these matters. I have a lot of clients all around the world, and I do make the process very simple for them. So thank you for listening. Any questions?
Yeah, I've got a couple more questions, if that's okay there, Laurence. Does the UK have a double taxation agreement with Zimbabwe?
I believe it does, actually. Yeah. Yes, I've got other clients in Zimbabwe. Yes.
Apologies, I don't think I've covered this one. Sorry if I'm not a UK citizen, do I have to pay full amount like UK resident? Yes, that's the answer. Simple answer to that, isn't it?
Excuse me, what was the question again?
If I'm not a UK citizen, do I have to pay full amount like UK resident? So I'm guessing taxes.
If you're not a UK citizen, the thing is, if you're an EU citizen, you'll get that tax-free allowance. So whatever net rental income you have to declare will be offset by the annual tax-free allowance of 12,570. So only the surplus will be assessed for income tax. And currently, the surplus will be assessed at 20% as basic rate, and it only goes into the 40%, the higher tax rate bracket, once it exceeds more than £50,000 approximately.
Thank you. Just there's something about deductible expenses. You touched on this earlier on. It's just disappeared.
Yes,
let me get it. Here we go.
Maintenance, etc.
What's the proof required that I travel to the UK for the purpose of inspecting my investment properties, then taking a holiday after that?
It's very difficult. I wouldn't encourage it. So it has to be you fly in and you fly out. The focus must be purely on the property. To claim the expense may attract scrutiny that you don't want.
Okay, thanks for that. Let me know if this is. You might want to take this onto a one-to-one. I have read that the purchase of 6 or more properties at the same time from one seller can be declared as non-residential for SDLT purposes. Assuming 6 houses at £100,000, how would stamp duty be calculated instead of a flat 5 or 7% for overseas investors? We're selling a block at the moment, so you're buying a limited company. So I'm right in thinking if you're buying a limited company, there's no stamp duty because you're buying the company rather than the properties, but the properties sit inside the company. Have I got that right, Laurence?
That sounds reasonable. It sounds likely. But I'd like to research
Yeah,
everything before I answer such
yeah,
complex issues, but that
yeah.
sounds likely,
I
yes.
know we've put together a package. It's, I don't know, 6 million. It's whatever it is, 30 apartments, and you're buying the limited company. So I know on the blurb that where we checked it, there's no stamp duty there. So again, we can have a sort of a one-to-one. We'll come on in a minute. There'll be another page just to click on
Sure.
if you want any follow-ups from myself, whether we're talking the market, property, mortgages, and obviously Laurence, obviously on the tax side of things. Just on the mortgages, just a quick one. How is borrowing eligibility and amounts typically assessed for a UK individual that owns a property on a mortgage and seeking to purchase their first buy-to-let? Again, a little bit like tax, sort of individual case by case, and we've got onshore and offshore mortgage brokers that can help. I've got one guy at the moment that's 62 years old. He's living in Estonia. We can get him a 50% buy-to-let mortgage on 160,000 pound property with no income because they'll take into account other assets and the rental income. So yeah, quite a lot of flexibility there as well.
Yeah, but it does require like the 50% deposit or whatever. Yes.
Yeah, that's 50. If this chap was earning more than 18,000 per annum, we can get him up to 80% loan to value. So again, depending on location, but we've got some great UK, well, onshore and offshore mortgage brokers that are specialists like Laurence that again can help there. So again, we can always hook you up with sort of one-to-one call on that. Abdul, how to hire services of a tax consultant while outside the UK. Click on the box in a minute, and then we can make an introduction, and Laurence will follow that up.
Abdul, I set up my company in the UK, but I'm currently in Dubai. I have a representative here in Dubai, a representative office here in Dubai, but I'm available to all expats, and you can contact me easily. Joseph Mews, Andrew will give you the details later.
How long? Another question. How long should it take ideally? How long should it take in terms of approval to get a mortgage? I think, again, if you said we could get you a rough decision now. So if you had a property, you'd speak to a broker and they'd say, right, this is your income, this is your current situation, this is what you want to buy. And assuming nothing changes, because if it's off plan, you'll get that sort of unofficial approval now, but it could be up to 18 months, 24 months before the property is ready. So as long as nothing changes in your circumstances, you know that you should be proceedable. If you're worried about that, you'd need to choose something that's ready to go now. But that it can be a fairly short amount of time, because if you get a mortgage offer now, it'll only last typically 3 months or 6 months. So of course, there's no point in paying money to get that mortgage approval when you don't need it. So again, we'll have a look at, we could have a look at that case by case and at least give you an indicative response to say, yeah, if your situation remains the same, then yes, you will qualify for a mortgage as things stand, sort of 18 months down the road. Excellent response, Laurence. So that was good. I would like to follow up offline on any questions claiming travel expense. So the next page, I think, will give you a click on link, and then we can get back to you on that. I think I've covered most things. There's a couple a little bit more complicated, more longer-winded ones, but
get in touch with me.
Yeah, get in touch, and then we can Laurence can come back with the other bits and bobs as well. So unless anyone's got anything else, I think that's about it. Yeah, so mortgage approval. Again, you get a sort of an agreement in principle now. If you're off plan, 3-4 months before completion, we're in touch to say, right, do you want us to furnish it? Do you want us to let it? Do you need a mortgage? So we work with you and the developer, because you need to have your mortgage ready. But then we work with the developer to make sure the valuer can get on site. So it needs to be finished so the valuer can get on site. And mortgage companies are a little bit slow these days, to be honest. So it can take 3, 4, 5, 6 weeks, but we're working with you. We're working with the developer, so we manage that process really. So there's we try and make it and do make it as stress-free as possible. You won't suddenly get a letter out of the blue saying, right, you need to pay your balance straight away, and we're serving notice. It's very much companies built on customer care and good service, and working with the developer, but more importantly with you, with our investor clients. So I think that's it. Thank you. Well, we'll just put the next slide up, which will be the little tick boxes for any further help and support, whether, as I say, it's property related, rental yields, tax planning, the market, or just a general consultation. I'm sort of UK, well, I am UK based, but I look after parts of the Far East, Hong Kong, China. John is in the UAE, and we'll cover all of that region with he and his team. And we've got Mark. I noticed we have some sort of South Africa or Africa questions. So Mark runs the South Africa office, and you know, him or one of his team will be in touch. As I say, does tax, mortgages, the latest investment opportunities. We've got a lot of nice product at the moment, the market. So anything else you need, get in touch, and myself, one of the team will come back to you as soon as we can.
Yeah. So with your investment plans, you invest as you wish to, but don't worry about the tax reporting consequences. I can help you with that as your plans develop. So continue to plan ahead and let me take care of the tax for you.
Thanks, Laurence. Really appreciate that. That was superb. Hopefully, everyone found that informative. We'll be doing, I think, we could do a recording, which we'll send out to people as well, and look forward to speaking with those that want to soon.
Okay. All the best. Bye.
Thank you. Thanks, Anjana.
Bye.
Thanks, Laurence.
Bye.